Well, good afternoon, everybody. Welcome back to another episode of the Industrial Real Estate Show. I am pleased to be joined by Fred Cassano from PwC, who leads up their national real estate team. And we're going to talk about all kinds of fun stuff today, markets and industrial real estate and all sorts of fun things. But first, Fred, thanks so much for joining me. I really appreciate you jumping on with us.
Awesome to be here. Thanks for the invite.
So this all stems from the recent report that PwC put out, the review of the real estate, which is 46 edition that's been put out. Can you just talk a little bit more about that report in general, so people just get an understanding of what goes into that?
Absolutely. It's our 46th year with to combine PwC and Urban Land Institute, ULI, and we produce this publication globally. So Canada, US, Asia Pacific, Europe, and we all release at the same time. And actually for Canada it's our 20th year, because before we used to be an insert for North America, and we said, well, no, Canada's a bit different. So it's now our 20th year. So what we do is we interview face to face 20 CEOs that help shape the real estate this landscape in Canada, together with 1,600 online surveys from North America. And together, we try to get a good cross section of Canadian institution, pensions, PEs, also developers, operators. So it's a good cross section. So it's not just biased on one side of the spectrum. And together, if these individuals plus the survey can't tell us what's happening, then we don't know, right? So it's a great cross section annually of forward-looking, what's going to happen 2025 and beyond, because real estate is long-term in nature. But so we try to capture what's emerging as a new theme for real estate.
Yeah, I've read it, I think every year since I've been in the business, and you could tell how much goes into it. I was even flipping through last week, just the amount of people that were involved in putting this together, and it's a full page of people that beyond just who's being interviewed and surveyed and that. So there's a considerable amount that goes into it. With your role as leading the real estate team, what's your background? How did you get into the space and then ultimately get into the real estate space?
So I joined PwC in 2006 as a manager. My accounting life started years ago in 1995 with Arthur Anderson. And then when that turned sideways in 2021, unfortunately, I went a different path, spent some time in the mining sector, which is, very, very interesting. But then I missed public accounting. So I came back 2006, and I was entrenched in real estate right away, because I was servicing private companies focused from a tax perspective, and made partner in 2015 as a tax partner, focused 100% real estate, and then just continued assisting with various tax transactions, and then more broadly with the real estate community. And I think I really clinged on to the Emerging Trends publication, because it helped us develop insights and points of view, but it's almost our give back to the community, right? To the industry. Because I think the more knowledge we have, either data-driven information, or just again, trends from key experts. I think it's our give back to the real estate world in terms of making more informed decisions. So unfortunately, not unfortunately, but I actually last year interviewed 40 individuals out of the 200, and together with my colleagues. And I think a ETRE junkie. I just love it. I just absolutely love it, because every year we think, what are we going to talk about this year? And there's just so much to talk about every single year. So I love it.
Well, you're definitely in the right space with a bunch of other real estate junkies, where that's what we all do too. We just all seem to live, breathe, and sleep it. So great to hear your background on that. And it'll be really exciting as we jump into some of the trends on what you guys have uncovered and what you think is going to happen in 2025. But even before we get there, we're almost at the end of December right now. It's almost at the end of 2024. What would you say this last year looked like before we get into what next year could or should look like?
Yeah, 2024 was really a year focused on capital constraints and how can you be creative when there's capital sitting on the sidelines, especially when we were competing with higher for longer interest rates and yields that are not as risky. So how do you attract that investment capital to real estate that is risky? So it's really listening to the creativity on investment raising, which has been very difficult in 2024, to the shine of the operators. The true winners in real estate going forward will be who can be effective operators of their property, right? Because for years, a lot of the, call it, operations went to the sidelines because the values had just exploded over the last 10, 15 years. But I think there's going to be more of a concentration on asset management, operations, really delving into performas in a big way. So 2024 is about working in capital constraints markets and being really focused on operations, right? So is that a good lead in for 2025? Yes, because we have a lot of catalysts that are coming our way. Lower interest rates, and yesterday that another 50 basis point reduction down to what 3.25 with a goal to get to 2.225 by the end of 2025. Referencing CIBC and a few other people. So that's a good catalyst for real estate. We're starting to see deal volume already pick up. Everyone thought 2025 was going to be a big year for deals, and it's already started, and we could talk about that for sure. And then so people during 2025 were getting their balance sheets ready, right? Getting ready for opportunistic buys, whether it's on the distress, whether it's for 2025 because of more incentives from government, especially on the multifamily, and now transaction volumes have started, which gives us comparables, right? So people are always saying, "Oh, there's not enough comparables in the market. I don't want to be the first mover." So that's starting to open up. So I think 2024 was about being creative, operations, getting ready for the next wave, and I think it's already started to happen.
Yeah, I've got a few questions on that. So first, when you were interviewing a lot of the people and they said that operations is going to become much more important, kind of reminds me of the oil companies when oil was over $100 a barrel and they just had so much money coming in that you could spend money with reckless abandon and you didn't even really need to worry about it because there was just so much money coming in. As soon as oil dropped, all of a sudden they needed to start being a lot more efficient and really looking at how much square footage they had and how many machines they had and how many employees they had. So I'm guessing that's a similar type of sentiment on the real estate side. Is all of a sudden, like you mentioned, that not everything was going up, so now you have to be more responsible. Did any of the people that you're speaking with suggest how they're going to do that? Because I think it's a great notion. Like, let's all be more efficient. But any insight into how to do that?
Oh, so many different aspects. The conversation about, do I outsource everything, or do I bring uh, property management internally, or
Mm.
or not only property management, asset management, construction management. So the whole conversation about outsource versus insource was live and kicking in 2024, and you're starting to see people take different directions in that regard. And you know what? No one strategy is the best. It's the fact that people are focused on what is the right strategy from a management perspective. Then there's efficiency from a data perspective. So for years, we couldn't really understand why real estate companies were not updating their ERP systems, right? That's because I think maybe they were making way too much money. Why break it if it's not broken? But I think we're starting to see a lot of investments in tech in a big way from real estate, different than in prior years, and that's because they need data-driven decisions to help on the management side, right? So there's a lot of money being spent in, call it Yardi and Yardi optimization, to gathering data for ESG and climate change, to assess risks on the assessment and quantification of potential physical risk, but also climate risk. So there's a whole area of ERP and tech spend that we haven't seen in a while, but I think it's rooted on the efficiency in operations, right?
Mm.
And the performance, right? So really stress testing the performance, what if oil goes up? What if your inputs go up? Now, factor in the tariffs to changes in tax policy. So I think there's a lot more focus on let's really stress test some of the components on our performance that weren't really stress tests because everything was going up, right? And it was potentially masking some of the potential mistakes of not having spent time on the performance. So I think hopefully those are three areas that are three examples of areas of efficiency.
Yeah. Thanks for explaining that. I agree. I think that it's never a bad time to get more efficient, and especially when you're in a bit of a rocky market to begin with. This is a good cue for people to really double down on that going into 2025. One somewhat related question, but just wanted to get your thoughts on this. So Canada lowered their interest rates by 50 basis points yesterday. The U.S. hasn't, and there's implications there. The dollar might get crushed in comparison to the U.S. dollar. That might already be priced in because Canada's economy is struggling compared to the US, which seems to be going quite well. Do you see, if the US doesn't lower, either in lockstep or even in some relation to Canada doing it, that our dollar gets crushed? And then a second question, the bond rates haven't adjusted. So anyone with a variable debt rate or floating debt, they're going to probably get some relief, but any new fixed mortgage, at least right now, it doesn't seem like it's going to move. So a two-part question: what happens to the dollar? And then if they keep trying to lower interest rates, but the bond rates don't move, does anything even change?
Yeah, those are awesome points. And certainly we heard that at the Toronto Real Estate Forum as well, when Benjamin Tal presented the long-term rate has not really moved because the U.S. is on fire or expected to be continuing to grow, whether it's adding the jobs or just overall sentiment on the economy. So that's gonna really matter when you go and get a loan or mortgage. It's the long-term rates. So you're right. So let's beyond the headlines. Even though there's a drop in the Bank of Canada rate, hopefully it translates into lower mortgage rates, but we're not seeing that yet, right?
Mhm.
And I think we need to see that because that's going to help with people affording homes, people affording a rental, getting shovels in the ground from a construction perspective. Like it matters. Cap rates, we want them to come down from a valuation perspective. So if lowering rates don't impact mortgages, it's going to be higher for longer again, and we're going to be in trouble. I agree with your point on we have to watch what's happening in the U.S. because if the U.S. is going to be in an inflationary period, they can't lower rates. And then if we're now in a recession and we have inflation in check, we want to stimulate. So that's going to have big impacts for our dollars. And there's always winners and losers when it comes to FX. But does that mask productivity? Because in the past, when our dollar was lower, there could be an exchange gain, and then that was masking productivity. And we already have productivity issues from a labor force. So we have to pay very close attention to the winners and losers on the FX, but again, we don't want it masking our productivity issues.
Yeah, for the people that are here from the US, it's a great time to come to Canada because your dollar will get stretched a long way right now. And the opposite for the Canadians, going to the US is very expensive right now because the dollar has gotten crushed. Canada's economy has lagged much behind just on a GDP per capita basis over the last 10 years. So it's caused a divergence where the US is, especially now that Trump's got elected, it seems that that's injected a lot of energy and enthusiasm into the market. And maybe this plays into what we see in 2025, but Canada's has been relatively flat. So look, I think that's actually a good lead in then. So all that taken into account, and where Canada really is and where we think the US is going to go, what do you think is in store now for 2025?
Yeah, so you mentioned foreign investors, so I'll try to bring that into answering your question. In a report, we do see an influx of foreign investment into Canada, mainly from US, UK, Korea, sovereign wealth, and Germany, because our fundamentals are still strong despite immigration being curbed. Right, there's still an imbalance between housing supply and housing demand. So that's attracting a lot of foreign investment, especially in the multifamily, because there's incentives, there's carve-outs for interest limitation rules. So we're starting to see an influx of foreign investment. So while Canada's GDP overall has maybe flattened, right? From a real estate perspective, there's still growth, and it's a safe haven from a stability perspective. Politically, when you compare Canada to other parts of the world, so it's still attractive from investment perspective. Then layer on the FX exchange, I think we're going to start seeing a lot more activity. And I certainly can tell you the transactions that are working on, excuse me, are all, for the most part, foreign investors coming into Canada, large platforms.
Hmm. What are their thoughts on it? Is it just that the exchange for them is better, so they can stretch the money further? Do they think that long term Canada just looks good? What's driving foreign investment?
Yeah, so as you know, real estate is really you have to delve into each asset class differently. We're still undersupplied from a student housing perspective when you compare Canada to other parts of the world, like the UK, like the US. So there's people interested in student housing, where we have lots of interest in senior living as well. I think a lot of investors were call it spooked during COVID at the state of our senior homes, and not a lot of attention really to upgrading and adding new stock. However, investors have noticed that, right? So there's interest in just demographic movement that we've been talking for years, that we're going to be undersupplied on the senior living, so that there's interest in that. You call it the industrial show. I mean, although there's the shine has maybe come off a bit, as we said in our report on rental growth for industrial, there's still lots of interest in industrial, right? Whether it's data centers, cold storage, small bay industrial, that's attracting a lot of interest from foreigners. So I think it's asset class specific, and then multifamily, right? Whether it's old stock across the country or not enough stock, multifamily is an interesting asset class.
Yeah, I'd love to jump into the industrial specifically. And for people listening, there's a few markets in Canada that are very large industrial markets, and Toronto being the obvious one. It's I believe it's the fourth largest industrial market in North America, and there's a considerable amount of inventory underway right now. I think they've got about 1 billion square feet of total inventory, and they've got another 15 million square feet under construction. So there's still some very large industrial markets in Canada. And from the report that you guys said, the vacancy rate nationwide is about 4.4%, which has crept up. And a lot of that's driven by the same problems afflicting other areas of a lot of inventory getting added to the market, anticipating that growth was going to continue, that 2021, 2022 levels. And now we start seeing vacancy uptick as a result of inventory outpacing demand. But I really like what you said there, because I think this is a storyline in industrial specifically, is that there's different layers of industrial
Right.
where a vacancy rate gets quoted and they'll say the industrial vacancy rate nationwide is 4.4% or whatever arbitrary number it is. That encompasses everything. That takes into account the 2 million square foot single tenant warehouse building that just got built and the 60,000 square foot multi-tenant industrial building that just got built with 3,000 square foot bays that perhaps are all fully leased, whereas the 2 million square foot building is vacant. Did you dive into these topics when you were trying to really identify areas of opportunity or perhaps areas of weakness for the upcoming year?
We did because we try to understand not all industrial is the same, right? The large bay, robotic, big distribution centers uh, potentially were overbuilt. So we were asking that question, and people thought that, and de-risking because you also we heard a lot of discussion about let's say that there's a downturn and you have one tenant, and it's harder to lease and find a new tenant when it's just only one tenant, excuse me. But then the de-risking elements shifted towards small bay industrial, and there's still not a lot of it, and e-commerce has not gone away. So how are we actually helping solve the last mile? So small bay industrial feeds into that. Cold storage came up again and again a few times, and also self storage. We didn't talk about self storage.
Hmm.
Is That's also helping last mile, but it's also helping other things as well. Um, Smaller living spaces driven by condos, and also people not having offices for whatever reason, so they're storing space or using that space differently than you would have traditionally used that space. So I think the conversation shifted towards smaller industrial being still in high demand, right? And then I also want to link to another category in our report that maybe you'll get to is Calgary, right? Because the cost of industrial to find the land, especially in your biggest cities, Vancouver, Toronto, is expensive, and that led to various factors for Calgary being at the number one markets to watch across the country. But one of those reasons was around finding land cheaper relatively compared to other provinces to build industrial, and then industrial being almost a central hub because of its vicinity both to the US and across Canada. Calgary became a destination to build the industrial as well. So a lot of factors saying just diving deep into why you can't just take a 4% number and apply it across the whole asset class. You have to bifurcate your asset class, especially for industrial, but that applies for everything.
Yeah, and then you even need to get more nuanced and get right into the individual market and then bifurcate down into small bay or heavy industrial, and like the metrics can be really different. I was talking to someone the other day, I can't remember the market, but a large US market, and they were saying that the vacancy rate for small bay industrial was about 2.5%, and the vacancy rate for their big bay stuff was closer to 10%. So
Mm.
it all averaged out somewhere that their vacancy rate was somewhere in the 6% range. But that's a huge difference. If you're just looking at the vacancy rate of 6%, but the big box industrial is 10 and the small is virtually non-existent. It's a huge disparity in those numbers. So I completely agree. I think you really need to dive into that further. Uh,
No different to office. Like office, I think
yeah, absolutely.
trophy assets, Class A, performing well. Your vacancies are coming down. The B category is still suffering. C, because it's cheaper, is probably performing a bit better than your Bs. But that's a perfect example, similar to your industrial. You have to really go into each asset class and try to find opportunities, and which is what one of our major themes in the report. Like, although the sentiment going into 25 is mixed, there's opportunities within each asset class.
Yeah, I'd love to actually just get your thoughts on the office because that's not something that I follow a whole lot. So I'd just be curious to know on the surveys and people you're speaking with, what is the sentiment? Do people come back to the office in 2025 now, or is this is a long-term trend that's going to take more time to shake out?
I think one of the quotes from this year was office curiosity during the 2024 interview season, which was positive because in the past, call it 2, 3 years ago, office was a bad word. No one wanted to talk about it, right? But the fact that people are talking about it, that bodes well for investment purposes. We're not out of the woods yet because there's still the financing institutions that are nervous around office. And again, it depends on the class, but that was a positive sentiment. Plus, then you hear discussions around foot traffic improving, mandates of people coming back to the office, and certainly we're seeing that from our own firm to you know landlords spending lots of money on upgrades, right? In anticipation of people coming back and making their spaces attractive. And then we see family office being the first movers on going long office. So you saw a family office in Halifax purchase 4 buildings from Oxford, and then a week later, also more office. This is in Calgary, right? So,
Mm.
so now we're starting to see office trade, which people are saying, well, it's at and maybe it's a high cap rates, but that's great. Those are transactions now in the office space. So I think all of that sentiment is going to bode well for office going forward. But again, it depends on which category, right? Trophy assets, highly amenitized, close to transit, close to hubs will perform better. Those offices in the suburbs, not close to transit, needing some TLC will probably do not so well, and they'll take a few years to turn around. And hopefully, if you're a candidate for an office conversion, which is not as simple as people originally thought, could be good for the bees, right? So I think office overall, the sentiment is definitely improving. Absolutely.
One thing that doesn't get discussed a whole lot is that industrial has an office component. It's very rare to actually find an industrial building, unless you start getting into niche areas like cold storage or self-storage. But almost every industrial building is going to have some component of office. And I haven't heard in the last few years that being a big issue. So let's just hypothetically say 100,000 square foot building, maybe it has 10,000 square feet of office, as a 10% office build out. That's still a considerable amount of office space that they're facing the same challenges, whether they have sales staff or administration staff. They don't want to go to the office either. But I haven't seen that be a big issue where a tenant would come in and say, well, let's blow out half of that and just convert that back to warehouse space. Did you hear any of those sentiments pop up where industrial operators or landlords were saying, you know what, we actually do need to address the office component of industrial space?
I must say we have not heard that.
And neither have I.
And I don't think it was discussed in a report, but I can say that what was interesting is there's still demand for industrial condos
Hmm.
where you're building to sell, right? I think Fiera was in this public knowledge. Fiera's invested in that space and is doing well. And there's not a lot of um, industrial condo units, which is interesting from a potential investment perspective. But to your direct question, no, not a lot of discussion on the office component within industrial.
Yeah, and same with me. Like I haven't either. I was just curious if you had anyone had brought that up because it still is a sizable or should be a sizable consideration, but it almost just seems like it's let's figure out the shop space. Let's figure out if this is going to work for the business on the operation side, and then we'll just work around whatever the office is. But at some point, something's going to have to give, because either there's going to be office space that has been demolished because it wasn't needed by the last tenant, and now the next tenant decides that they need it, or there you just have this large swath of office space in these industrial buildings that's just unnecessary. And if a tenant's paying rent and operating level expenses on that space and they're not utilizing it, at some point it just becomes inefficient and dead space. So I'm with you. I haven't heard this become a concern, but I just wonder if why. And my only answer for that is I just think that it's the last thing that tenants consider. But how much office space out there right now inside of industrial buildings is underutilized? Just be an interesting thing to explore.
It would be interesting. So could be a question we investigate next year.
Yeah, I'll also ask some people as well. So if I can offer you any insight that I hear from people on just their utilization levels of office space within industrial, I think that'd be a fascinating thing to uncover. On the warehouse space itself, automation must have been a big topic that came in on how companies are either looking to use robotics or retrieval systems or any type of AI in there. What was the general trend that you heard from companies in that regard?
Well, let's break it down, because the whole AI conversation is really interesting, because you have almost two um, microcosms happening. You have large investments in data centers, right? Fueled by AI, Gen AI, and the storage of our data. Yet there's not a lot of individuals actually using AI to the extent that we think it's going to happen, right? So there's almost like a disconnect that's probably going to merge somewhere in the middle, and a lot of people are saying it's actually going to happen really quick. So a lot of investment from getting ready from a data center perspective, but the use cases overall for real estate companies still exploring, right? And I think we used people are tweaking with it, right? But I think 2025 will be a year where we actually see the use cases expand significantly. And we're starting to see, you know, people not wanting to be first movers on the use of AI because of governance issues, risk, and which are all very valid reasons. But once you get comfortable with that, once you clean the data, then you have efficiencies. And I think you'll see the two worlds collide, in that the use cases will support the big investment in the data center. So I think you had a few questions in there. You mentioned AI, so I latched onto that one point. On the robotics, yeah, that's a big CapEx spend, and it's not for everyone, but I think we saw a lot of the CapEx spend happened a few years ago, not as much in 2024, right? Not sure if that trend is going to continue, because again, the tenants occupying those spaces are significant. So I would say the volume of tenants that are focused on robotic warehouses is probably smaller, right? So I think that maybe you're wrong, maybe I'm wrong, or maybe our report didn't uncover it, because again, the data center spend will probably capture the next wave of investments in large bay warehouses housing data centers. So I'm not
Yeah,
sure, if I touched. There was a lot of questions on there, but maybe what are your thoughts on what you're seeing?
yeah. Well, Kevin O'Leary, the promo man that he is, came out and said that he wants to build a $70 billion data center in
Yeah.
northwest Alberta by Grand Prairie. And I think he's a showman. So $70 billion is a big number. I think that there is a big appetite for data centers, and I hear the word data center way more than I ever have, especially in the last couple months. Everybody's talking about data centers, and I think it's appealing. You get a significant investment. You start getting some tax revenue. You probably get some minimal amount of jobs, not nearly as much as if it was an equivalent sized warehouse or factory, but you do get some jobs. But I think it's just the capex that gets people excited about it. But we only need so many data centers, even though it's projected to grow. I think there's some report that said 9 to 10% a year for the foreseeable future. That will require some more data centers, but how many more? Like, if are we talking 30 more mega data centers in North America? That would, if we put enough of that in there, that probably would satiate most of the upcoming demand. That's 30. Like, do we really, is that really going to move the needle on a market of 22 billion square feet that the North American industrial market is? Is that really going to move the needle by us building 20 or 30 data centers? I guess I'm cynical that there's a lot of hype behind it, but I don't know how much it actually changes the market.
Yeah, there is a lot of hype. I think the biggest issue with the data centers, and I'm sure we all know this, is the power, right? The
Mhm.
impact to the grid. And I think that's why Calgary is another reason for why it's listed as a top market to watch, because they publicly have said we're open for business because we for data centers because we have the power, whether it's fossil fuel, alternative energy, nuclear, right, and distribution. So if you can get over the power issue, which is a big issue, right, then it has to go hand in hand with your investment in data centers. Because if you can't fuel it, because you can't rely on the grid, there is no data center, right? And this is
Mhm.
a growing concern, not only in Canada but worldwide, to the point where there's places in the U.S., specific states, they do not want a data center because it's going to have an impact on your grid. And then, socially and from an ESG perspective, it's a big issue, right? But if you have the power, right, and you have land available in a cold climate, like that's Calgary, right? So I agree with well, I agree. I support the thesis for Kevin. I think again publicly there's been other investments recently. Fengate with E-Structures in Calgary. I know that Invest Alberta publicly announced during the Calgary Forum that there's 20 or so other companies interested in understanding more about data centers in Calgary because of the all those reasons I mentioned. So, I think the you're right. There's a lot of hype, but it could be very real given the the usage of Gen AI data storage fueling data centers.
Yeah, I'd love to get your thoughts on this as well, because one development that I see, and I'm not a data center expert, so this is more of just me being an interested, curious person in it. But data centers traditionally were used for cloud storage. I say traditionally, like it goes back decades, when really it's gone back maybe 10 to 20 years. But traditionally, data centers have been for cloud storage.
Right.
And to do that, you needed to be close to massive population bases to have the connectivity and the latency issues, and to avoid really those delays. That's why so much is clustered in Virginia or clustered close to major cities. With data centers now catering a lot to AI training and development and these large language models, you don't need that connectivity to a large population base. So all of a sudden, instead of saying we need to be in Virginia because this is where so much of the dense population is, we can now go and look in a cold climate. If we can get power, you get powered by natural gas, get it off the grid. You don't need to be concentrated so much closer to that. So I think if, and again, this is me just trying to patch together what I've read about, is that all of a sudden Canada could look very appealing, because you don't not it, data centers are also very heavy in water usage to keep the systems cooled. So you've got massive power requirements. And what's crazy, and I don't think a lot of people appreciate it, a million square foot data center is going to generate somewhere in the neighborhood of a gigawatt worth of power. It's going to require about a gigawatt worth of power, which is also the equivalent of powering somewhere in the neighborhood of a million homes. So it's a staggering amount of power that goes into one of these things. But then you also have the water issue. And now if you don't need to have those next to a major population base, all of a sudden somewhere in northern Alberta could look appealing. Is
Correct.
that is that a safe thing to how to describe it on how like it's evolving from cloud storage based data centers to now AI training data centers, and that latency and connectivity issues will evolve as accordingly?
Yeah, so I'm also not an expert in this area, especially when it comes but I agree with what I've understood, that you don't have to be close to the core anymore. You could have your data center powering Gen AI large language models uh, in other areas, including the Nordic countries that would help fuel, data in Toronto, right? But you're right, Canada could be a candidate. However, it's what's the impact on the grid
Mhm.
if 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 we don't get the alternative energy correct, including the conversation around nuclear, which is why you see AWS, Google, Microsoft all make announcements in October related to their own small nuclear reactors fueling their data centers.
One other thing that I'm very fascinated to watch unfold on the data center side is what happens to these buildings in the event that technology keeps increasing as technology historically does. It gets smaller and more efficient. And I remember I found a camera that I had from like 15 years ago, and inside was an 8 megabyte memory card. You couldn't even take a single picture with an 8 megabyte card now, because you can get some that have 256 gigabytes, some cases terabytes, so that you keep getting these more efficiency in technology. Is there a risk, and maybe this just hasn't come up, but with data centers, is there a risk that they're building all this infrastructure with today's technology, all today's server technology, and at some point I'd have to assume that some breakthrough, quantum computing or something, comes where they're able to consolidate that down so much that now you have all this real estate out there that was purpose built for data centers. And I would equate it actually to an office to residential conversion, where it might be possible to convert that to a warehouse or something, but it's not going to be easy. It's going to be some kind of Frankenstein result. If we're building this huge amount of inventory for data centers on today's technology, assuming that the technology continues to advance and shrink in size, does 20 years out, do we have way too much data center space?
Yeah, I have no idea. I mean, it's a great question. Um, as you know, every time there's a scarcity issue, it takes one reinvention, and all of a sudden the business model is reinvented. So I think it's a valid question. And to your point, you know, whenever there's all this hype, it could lead to potential rethink few years from now. So I don't know. I don't know how to answer your question, but it is a good example of the convergence of so many different areas. You have real estate,
Mhm.
big tech, energy, government, all coming together. And from an investment perspective, we always say the old adage of how you're doing your benchmarking, your ROIs, calculations, if you just go at it with one single asset class, um, it's going to be scary because there's a conversions of, especially with data centers, or we're calling it real assets, that's it's making the investment thesis challenged. And to your point, is the hype too much? And in the future, maybe there will be a business model reinvention. So I don't know. That's a very good point.
Yeah, and sometimes I just ask questions, knowing that there isn't an answer, because it's something that I like to think about. It's one of the reasons I love your guys' report, is because you're asking questions as well. And what does next year look like? What does the future look like? I think that these are important questions to ask, even if there isn't a neat and tidy answer. It's just having it on the radar. And one thing that I would say too is that because there's so much hype for data centers, is that the conversation comes up all the time. The one thing that I always highlight is it is very, very complicated to get a data center going for the reasons that we discussed. It is very, very difficult. So if someone's just thinking, you know what, I should build a data center, maybe I'll do that in 2025. It's
Yeah,
brace yourself for a very painful experience going forward on that.
not for everyone. Absolutely.
We're at the top of the hour. If anyone has questions for Fred, please put them in the chat. But I wanted to just wrap up on, you mentioned Calgary is the number one market. What are some other interesting markets you guys identified?
Well, Edmonton is number 5, and it's been increasing as well, mainly driven by affordability, whether it's immigration directly into Alberta or net migration from Vancouver and Ontario, right? Or BC and Ontario. So I think Edmonton's also houses a lot of government employees, and I think they're also being mandated back as creating a more vibrant office market there. Still, the vacancies are high, but I think I keep your eye on Edmonton for sure for those two reasons: net migration, immigration, and then mandates back to the office. Um, Vancouver is always is interesting because they have a large population growth as well, but the stock of rental is old, so there's a lot of investment going into multifamily to deal with the affordability crisis because people want to live in Vancouver, but home ownership is out of reach. So multifamily becomes a really, really good investment. So we're starting to see a lot of dollars going into Vancouver for multifamily. So yeah, Edmonton, um, Vancouver, and of course you can't count GTA out. I mean, it's still a very popular destination, lots of growth. I think the biggest friction that we heard in our report, more so this year than last year, is transportation congestion. And it's probably going to be topic for probably years to come. But that's probably hindering a lot of growth because of the infrastructure problems, right? That the GTA has. I think the other two topics, and we are at the top of the hour that we didn't talk about that we should, is around climate. That was big in our report, and on the labor issue. So people are not talking about it enough, but labor is going to be a big issue because shovels are not going in the ground fast enough now. But as incentives and maybe capital comes into the residential space, what's going to happen when we want to all build at the same time, right? So sure, your costs have come down a bit, right? And Altus is on the record saying that maybe costs have come down, overall. I think it was it 10% reduction, but it's not going to be the case going forward. So what's going to happen when we all start building from a labor shortage, labor productivity? Is the way we build going to be a lot different? It has to be, right? Well, we finally start seeing a bit more modular because we haven't seen that in a big way. So labor and climate we haven't talked about.
Yeah, and I'm always shocked at how fast an hour goes when we do these calls, because I did want to explore more topics with you, and it's crazy that an hour's gone by. I suppose that actually is a good teaser, though, to get people to download your report, and then they can read on those topics in more detail. Because you're right, I think those are definitely worth exploring. But in the interest, I know Sal, he needed to drop off. He said, "Great call, thanks, Fred." There's perhaps a conversation we could even pick up next year as well, and just get your thoughts on what's happening as we start rolling into 2025, and then we can talk about those issues in more detail as well.
We do have a point of view on climate as it relates to real estate coming out shortly, but that's something we definitely could delve deeper into. It was surprising for us to see that not a lot of real estate companies had a climate assessment and then quantification of potential climate risks. And it's surprising because we've had severe weather, whether it's wildfires in the west to deep freezes in Montreal to flash floodings in Toronto, like mudslides. So to not really have broadly focus on quantifying climate assessment and risks is going to be a trend in 2025. People will get on board because investors are starting to take note from a valuation perspective. Insurance companies, I think OSFI has a B15 guideline in terms of ensuring that companies are focused on climate assessment. If not, then guess what? Your premiums are going up, right? And that's going to have an impact on your performance. And then three, and cash flow. And then three, more disclosures. So I think 2025, if you want to go deeper, probably invite one of my colleagues who leads our climate change initiatives for the firm. We're doing this POV or point of view together. I think that could be an interesting conversation, right? Because it was highlighted in a report, but I think more people, more real estate companies are focusing on assessing climate change, climate impact, impacting investments, right? The physical risk, but also the costs of shutdowns. Like, I'm not sure if you have 2 more minutes.
Yeah, absolutely.
Share one example. Like, we did our own analysis of our 18 York building for PwC, and I guess we were fine from a climate assessment, climate risk perspective. But then in the summer, remember we had the flash flood. We had to actually shut down our building because the power facility was 5 blocks away. Well, that impacted our productivity. We had to shut down and we had to fix things, getting people out, safely. I'm not sure if people were trapped in the elevator. Maybe they were, but they were walking downstairs. Like, so the whole shutdown was impactful to us. Now, it didn't create a physical risk, but it impacted operations, impacted safety, impacted other measures. So I think people are starting to take note that it's very important to assess physical, but also operational risk.
Yeah, well said. Yeah, I would be very interested in seeing the report when you guys put it out and talking to one of your colleagues on it, because I agree that is going to be a major trend going forward. So yeah, thanks for sharing that, and thanks for taking the time to jump on this as well. It's I found that very informational and helpful. So great insights. Really appreciate your wisdom on that. And I just want to so we'll put a link to where people can go and get that report. Like you said, there's a Canada one, there's a US one, other markets too. Did you say, or is it focused mostly Canada, US?
Europe, Asia.
Okay.
I think there's a global one as well, so I can share those links with you.
Yeah, that'd be great if you could. And if someone wanted to reach out, connect with you, or are you on LinkedIn, or what's the best way to get in touch with you?
LinkedIn's probably the best, and then we can take the conversation to my email, but LinkedIn for sure.
Okay, perfect. We'll put a link in the show notes to this. I'm going to try and get this episode out probably on Monday, so it should be live on Monday, and I'll share that link with you as well. But yeah, thanks once again for sharing your insights. I thought that was excellent. Thank you.
Lots of fun. We'll chat soon for sure. All the best.
Sounds good. Okay, thanks again, Fred.